Streaming from Oklahoma's own digital studio, this is Dave Davis with Your Money Matters.
This is Your Money Matters. We're talking about money today with Josh Herlan at Future You Financial. This is our live digital platform. Josh, how are you doing?
Good. Thanks, Dave. Thanks for having me on today.
So
Excited
this
to
is our
be here.
live digital platform. This is the fourth time that I've done it so far, so we are still getting some of the technical things worked out, but as we're talking about bonds, you know, it's interesting, Josh, we were emailing back and forth and you saw my report recently about gold and the prices of gold and people investing and going up and down. So tell me about, okay, so you're thinking about gold and then we're thinking about municipal bonds. What are kind of the things that kind of got you thinking in that way? Because they're both maybe, I don't know, non-traditional investments or maybe investments that people don't think of. What do you think?
Sure. I would say gold is an alternative asset class. And really, like Warren Buffett doesn't believe in investing in gold because it doesn't produce anything. It's just kind of a fear trade, right? So when fear enters the market, people kind of tend to rush to gold and it spikes and it goes high. So people are concerned about the national debt, they're concerned about the dollar, and so you're seeing some, gold hit all-time highs lately, which can be great. And we use gold as kind of a hedge in a portfolio for exactly that situation, right? But it doesn't produce a dividend. So if you're retired and living off a fixed income or want to tap your portfolio, yeah, gold can help mitigate some volatility, but gold can also be very volatile. And further, it's not going to produce any income, right? So another thing to look at right now, we're doing with a lot of clients is considering more of an investment into municipal bonds. A lot of our clients are higher net worth, and municipal bonds are simply, giving a municipality, loaning them some money for a fixed period of time, and then they pay you back, and it's better. The income is federally tax free, and if you buy them within the state of Oklahoma, for example, like Oklahoma Turnpike Authority bonds, the state income tax is also tax free. So you can get a decent yield on bonds right now. Further, the price of interest rates and bond prices move in opposite directions, right? So we've had the highest run up in interest rates in like the last 40 years or the last couple of years. The markets have held on really strong, and it's really impressive and kind of an economic miracle that the markets have done so well. So we're all really happy with the markets. There is kind of a FOMO trade, a fear of missing out, I think. And so you could just look to rebalance a little bit and maybe consider some municipal bonds or adding to your bond portfolio, because when interest rates go down, the price of these bonds should come back up.
So let's take it one by one, and that's great information, Josh, but let's take it first. So if I am buying a municipal bond, what am I doing? What does that mean?
Yeah, there are a lot of ways to buy a municipal bond. You can go to your brokerage platform of choice and buy them individually. We've been helping a lot of clients do that lately. Or you can buy a bond fund, and that's kind of a clean, easy way to do it. Right now, we're looking at bonds or bond funds and about the 10 to 15 year maturity to duration. And you're going to maybe get 4 or 5%, maybe tax free or federally tax free on that money. And you're kind of locking that yield in for that period of time. So I like individual bonds because I get more control over when to sell the asset.
And just, taking it bonds 101, like we were talking about, like bonds 101, this is the starter course, this is the primer course. So if I'm buying a
Yeah,
bond, I'm lending that company or a municipality or state or turnpike money, like I'm lending them
that's
money,
right.
and then that pays
That's
me
right.
interest, right?
That's correct. Yeah. So on a new issue bond, maybe you loan a company or a municipality $1,000, and the coupon might be set at 5% of that $1,000, right? And maybe it's a 30-year bond, Dave. So you have 30 years for that company to go bankrupt, default, out of business, or interest rates to go way up or way down. If you're getting 5% on your bond and tomorrow they raise interest rates and you can buy a new bond, the same bond almost, and get 7%, then the price you're going to get on the one you have is probably going to go down. And so that's kind of how the bond market works.
And interesting. So the Federal Reserve, depending on what they do, how many more meetings do we have left? And are we expecting, okay, so if they then go down, that bond yields could go up? Kind of two questions there. But first of all, do we think interest rates are going down this year?
Well, in the business we call it the Fed put, and so typically when the economy gets in trouble, the Fed uses interest rates like a gas pedal or brake, and so if the economy starts to falter, typically the Fed is very data dependent, and they'll look at the metrics and say, well, the economy's slowing down a little bit. for various reasons, and let's lower interest rates to spur the economy back up. And when that happens, and if that happens, that should help bond prices. Now, conversely, be aware of the risks, because if, say, inflation ticks up due to inflation or tariffs or whatever that is, you could see those bond prices come back down, right? So you have to be sure you understand them all, but again, just understand the risks that you're taking with them.
Right, and I wanted to talk about, so when people think of risk, maybe you think of the stock market, and we're talking about all these returns despite, multiple administrations, the stock market's above 40,000. I mean, we're talking just, it's been really interesting the last several years to watch the economy do what it's doing, and then the stock market continue to march up. So what are kind of like, when the stock market does this, then bonds do that? What are kind of the typical reactions and the interplay between the stock market and how that's affecting people's retirement right now, and what's it doing with bonds?
It's really hard to say, Dave. I think they kind of work to, you want to find non-correlated asset classes, right? And so bonds are less correlated than, say, the S&P 500. But if we get a recession, your bond prices could also come down, right? But again, that probably would be more of a near-term issue. We get a recession, bond prices come down, and then hopefully interest rates, and you start to see those bond prices come back up, right? So when you're investing in bonds, that's why maturity really matters. Like a money market fund is essentially a very, very short-term, ultra fixed short-term bond, municipal fixed income product, right? And it's moved to stay at $1. It doesn't go up or down. Then right now you're getting maybe 4%. But you can go further out that ladder for maturities and durations and kind of extend that risk and hopefully increase your yield to maturity, or the yield on those bonds.
So the money market, and you brought up the money market, a lot of people may have these. You're talking about kind of like a savings account that gives you 4% interest. You have access to it. It's essentially liquid. What is a big difference between, okay, I want my money in a money market where I may have access to it, versus I want to buy some bonds and it might have a better yield rate, but what are the differences between those two? If you're thinking, well, how should I get 4%? Should I get 5%? This bond is doing 6% over here. What are the differences?
Well, there's no free lunch, right? So you kind of have to weigh your risks and rewards. Money markets are great right now because they're daily liquid. They're designed to always stay at $1. So I can put money into my online brokerage account and get 4% yield on my money today. I can cash out tomorrow and get my money the next day. So it's wonderful, and the value of that shouldn't go up or down. But the interest rate on that bond will go up and down, right? So if they raise interest rates, my money market yield will go up almost immediately. And if they lower interest rates, my money market yield will go down. So if you think interest rates are coming down, it might be a good idea to maybe lock in that rate by using, say, a CD, 6 months, 12 month, or creating like a CD ladder where they mature. Maybe put $1,000 into a CD ladder, and every quarter $250 matures, right? And just keep rolling those forward, so you're kind of capturing the yield curve, right? Or you can step out a little bit more and look at some municipal bonds, like we were talking about, some municipal bond funds, or even some corporate bonds to kind of lock in that yield and protect your yield, and reduce your risk of a equity portfolio if you choose to.
Josh Herlan with Future You Financial, thank you so much for joining us live here in this live conversation. We're talking about our digital studio, our streaming desk. We have all kinds of experts, and this is a topic, Josh, that I'll just be honest, I knew the least about, and this has been really enlightening for me, and I hope folks at home during this live interview, and of course we're going to post it later. It's going to be on YouTube, It's going to be on social, it's going to be on newson6.com, but I really hope that folks are getting something out of this that they didn't know before, because bonds, are bonds intimidating, do you find, to your clients? Because like me, maybe they don't think they know as much. Like stock market, you kind of think, okay, I can see like my account, and I can see my retirement, my 401k going up and down, and the news is saying stocks are good, so okay, stocks are good. Do you feel like bonds is more mysterious and kind of requires more of an expert's touch to say, hey, here's this and that, or is that just my perception?
I don't know that it's any more complicated, Dave. I think they just haven't been in vogue, right? When interest rates have been going down traditionally, and so bonds have been kind of a bad investment. You don't want to invest in bonds when interest rates are plummeting, going up, because your bond prices are going to go down. But we're in a kind of a new environment where now you can get a decent yield on your bonds and lock in that yield. So, yeah, I think it's an interesting time to look at the traditional bond portfolio.
And one last word here, Josh. let's talk percentages of your portfolio. And I know everyone's different, but the kind of thing is like, okay, if you're doing like precious metals, gold, probably shouldn't be more than 10% of your portfolio. Five, you'd say five?
Say five, yeah.
Yeah,
Depends
five.
on who you are in the day, but yeah.
So in other words, a diversified portfolio. We talk about that all the time. Experts talk about that all the time, the diversified portfolio. Do you kind of have a magic number for municipal bonds in a portfolio in terms of percentage?
Well, we want to think of our money in terms of buckets, right? And so maybe you want to keep 1 to 3 years living expenses in municipal bonds or corporates too. And that way, if the market does crater, you have some time to ride it out. If you need, so you're not tapping your portfolio at market lows, and you can use those municipal bonds, which should be less volatile, to access income and liquidity in your portfolio. So, there used to be the 60/40 portfolio, which was 60% equities and 40% bonds. And that kind of went out the wayside, right, during quantitative easing in 2009 because interest rates went to zero, more or less. And we coined it, the Wall Street coined it TINA, standing there is no alternative, meaning you had to go to equities to get a yield, right? And so I think now we're coming out of TINA and people do have options. So.
Josh Herlan with Future You Financial, thank you so much for your time today. We really appreciate it, Josh, and I hope we'll speak again soon.
That'd be great. Thank you, Dave.
So that was Josh Herlan again, Future You Financial. He's the founder, CEO, also an investment advisor there, and we so appreciate him joining. We're going to have a continuous kind of panel of experts, a group of experts that we're going to bring in every week is the goal here on the News on 6 streaming desk, our digital first platform. We're going to put this out on YouTube, on social media. You'll see it on my social media as well, on newson6.com. This is live right now on YouTube and newson6.com. So thank you for joining us today. And of course, this will be posted in case you missed any of it. So today we're talking about bonds. We've talked about all kinds of things from gold, stock market, general economy movement, and what's going on. Should I be scared, concerned, on watch? What is happening with tariffs and inflation? We cover a wide variety of topics. So next week, I'm going to be trying to line up an expert, and I hope you watch out for this. So this is going to be about June 15th, June 16th. We want to talk about college graduates and high school graduates, many starting either their first job or their first really career job out of college. What should you do with that first paycheck? Again, part of our commitment here at News on 6 and with Your Money Matters and this segment is that we want to make topics that are relevant to you. And even if they're these big, hairy topics that kind of sound intimidating, we want to make everything relevant to you and our viewers. So we thank you so much for joining us. Again, thank you to Josh Herlan with Future You Financial. We do appreciate it, and we will see you back again here soon on multiple platforms across the News on 6 family. See you then.
Thank you for watching this Oklahoma's own digital studio stream. Stay with News on 6 online and on television anytime for the latest news, weather, and sports.